Okay, so if we have a merchandising company, we're going to have merchandise in our location. We have to carry inventory that we sell in order to earn a profit. And the way that we account for that inventory is one of two different ways. One way is called the perpetual inventory system that you see here, and the other is called a periodic inventory system. So under a perpetual inventory system, every time a piece of merchandise is sold, we're not only going to just record the revenue, but we're also going to compute and record cost of goods sold. So we're actually going to have a two-part journal entry here every time we sell an item. Under periodic inventory, all we're going to do is record the sale, and then at the end of the period, we'll actually compute and record our cost of goods sold. Now, in most instances today with computers, a perpetual inventory system is pretty easy to do, and a lot of companies have now adopted perpetual inventory. And you can recognize this, for example, when you walk into a store and maybe they don't have your size pair of pants, and you say, hey, can you check and see if they have this at another store, and they can look it up and tell you. I've actually heard that within 20 minutes from the time you buy something and it gets scanned at the register at Walmart, it comes out of their inventory. So if you were to say, hey, do you have any more of this particular item, they could go in their computer and tell you exactly how many items that they have on the shelf. Now we know there's some flaws in that number, but in general, under perpetual, it keeps a rolling inventory record for the company. Now under periodic, that's not true. They can tell you how much inventory they have available for sale, but they can't tell you exactly how much they have on hand without physically going out and counting it. So we'll start with a discussion of periodic. I'm not going to spend as much time on it because, again, I think more and more companies are using our perpetual. It's just in general a better inventory system if you can use it. So under perpetual, we just record the sale when we make a sale of an item. So at the end of an accounting period, when we want to calculate what our cost of goods sold is, we have to look at what our beginning inventory was for that particular period, add to it any purchases that we made during that period, and that will tell us our cost of goods available for sale. Again, very descriptive. It's the cost of the merchandise that we have available for sale during that particular period. Then we need to do a physical inventory count of some kind to determine how much inventory we actually have on the floor, and then we can calculate our cost of goods sold and go ahead and update and make that journal entry. Now let's go ahead and switch focus back to perpetual inventory system. And let's look at what those particular journal entries are going to look like. So we will debit inventory or merchandise inventory when we actually buy merchandise. So here's an example. We debited inventory. I'm going to go ahead and write on here. So when we bring in merchandise into the business, we'll debit inventory. And that's going to increase our inventory account, and then we'll credit cash. Both of these are assets. That will be a credit decrease in cash. Both of those are assets. And that will just be the recording of purchase of inventory for cash. Now if we buy inventory on account, it looks very similar. We're still going to debit our inventory account, so our inventory goes up, but we're going to increase our liabilities now, which is accounts payable. So instead of crediting cash, we will credit accounts payable if we buy that inventory on account. Now if we're going to return something, we're just going to reverse that journal entry that we just made a second ago. So in this case, we would debit accounts payable and credit the inventory account. So this would decrease our inventory, and this is going to decrease our liabilities. If we paid with cash, we would debit cash instead of the accounts payable. Now just like, or I shouldn't say just like, now sometimes retailers will offer you a discount to encourage you to pay promptly. One of the biggest issues with owning a business is getting your customers to pay you and pay you promptly and on time. So to encourage that, a lot of times companies will offer you a purchase discount for prompt or early payment. Again, it's a way for them to get their money sooner so they can pay their own bills. And the way that those are actually expressed is similar to this. So you might see 3, 15, and 30. That tells us we get a 3% discount if we pay it within 15 days, or a net discount if we pay within 30 days. Now you could see any variation of that, perhaps something like 210 net 60. That would mean we get a 2% discount if we pay within 10 days or pay the full amount within 60 days. Here's another one that they mention, but I've never seen. EOM just means pay the full amount by the end of the month. So if we do get to take a purchase discount, what that's going to look like is we're not going to pay the entire, say, $7,500 that we owe in this case. And I know it's $7,500 because here's the amount that we debit to accounts payable, and that reduces my liability accounts payable, so I'm paying it off. I'm not going to pay the entire $750 because I get to take a discount. So instead, I'm going to credit my inventory account. Because my inventory now didn't cost me $7,500, it only cost me $72.75. So I need to credit my inventory to reflect the discount that I was able to take when I made that purchase. And then we'll credit cash for the difference between my liability to the company and the discount of $225.